and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. It was a big bounce back day for markets with major indices closing near session highs. We'll dive into the rest of the day's market trends. Then, home builders and home buyers are both staring at higher prices thanks to tariffs and inflation. We'll explore the current state of the housing market. Plus, we'll hear from the CEO of Rubrik on fourth quarter earnings and what's next for the data security company. Well, home builders facing a litany of issues in the housing market, with tariffs adding even more pressure. And our next guest says that consumers are likely to bear the brunt of that cost. Joining me now, Adam Wolfson, founder and CEO and CIO of Wolfson BTR, which is a build-to-rent company. So thanks so much for coming in. Appreciate it.
Thanks for having me.
So let's talk about tariffs, because the National Association of Home Builders has estimated that we could see an additional cost for home buyers of everything from $7,500 to $10,000 per new home built because of tariffs. Is that what you're experiencing? And walk me through what that looks like.
Yeah, I mean, look, we're a rental company, right? So it's a little bit different for us.
Sure.
But at the end of the day, I've seen estimates that equal what you've seen. I've seen 6 to 14% out of some economists. But at the end of the day, I think what's driving this is more uncertainty than the tariffs themselves, right? Just like when lenders had to deal with the fastest on record interest rate increases, which we just had, what you had was the base price of debt that obviously got more expensive, but what you really had on top of that was pricing in of uncertainty. We didn't know how long the rates were going to run, and we didn't know at what point they would stop. And I think a lot of what you're seeing right now is the same thing. Right, you have the base materials price that the builders are building in, that the suppliers are building in, but then on top of that, they're adding a contingency, they're adding a cushion on top of that. And so I think temporarily you're going to see an outsized response to that in terms of pricing.
So that contingency, that sort of surcharge, if you will, that's already happening, right? They're not waiting sort of for a full suite of tariffs to put into effect. They're saying, okay, we need to make sure we're going to be covered here.
Correct. I mean, look, so home prices have gone up about 30 to 35% since 2020. Before that, when companies like us would deal with a public home builder or contractor to do a job for us, they would build in essentially their own contingency, but they'd give you a guaranteed maximum price bid. You knew what your price would be. Post-COVID, none of them will give that to you anymore, right? Because they understand that. So they already have this mechanism for dealing with high inflation and costs, right? And so that's the same thing right now that you're seeing. They are refusing to lock in pricing. They are expanding the margins in their contract by which they can increase your cost as a rental home operator, right, as a buyer of their homes, or as when they're your contractor. And so at the end of the day, what you really have are the builders just building in more mechanism for them to be able to increase the cost and pass it on. And ultimately, those costs will wind up going through to us as a developer, or directly to the home builder, buyer, or the renter.
Well, and just as we've seen home buying prices go up, we've also seen rental rates go up, right?
Correct.
I've seen a couple of different estimates from different places, but both of them upwards of $2,000 a month is the average rate at this point. For you guys, are you already starting to push up those rental rates as a result of having to eat some of these increased costs?
Okay, for the moment, I don't think the market will bear more than sort of what we're already renting units for, right? As an operator, you're always going to try to push the rent to the place where you can fill your community, to call it 95% occupancy, to quote unquote stabilize your property, right? I think that at a certain point, though, what you're going to see is other projects that will get shelved because the rates that you can charge simply don't increase just because the cost of the materials are increasing. So I think that what happens in that case is the supply-demand fundamentals sort of shift, because there are fewer communities that will be available for rent, for sale. And so at that point, look, you had 500,000 on average too few homes built per year in basically the past 10 plus years. And what happened in that 10 plus years, the price of homes just surged with that. Price of rentals surged with that. And so I think any slowdown in the ultimate number of homes that are produced, whether for rent or for sale, that's what's going to push the rents higher, not just us choosing to.
Well, and as we know, the home ownership rate in this country has been coming down. Correct. With the affordability problem increasing. What has that meant for your business, and what demand there is for rent and that sort of balance between the two?
I mean, that's where our industry was really born from, right? So you had this 500,000 per year home shortage that was going on all this time. And so estimates now are 4.5 million to 7 million homes that we're shy in this country to meet demand. And so when you think about what that means, look, people used to rent an apartment, right? And when they were at a lower or earlier stage in their lives, they would rent perhaps their own first one-bedroom apartment. They'd get married, maybe they'd stay in a two. But from 1990 plus, the multifamily industry only really built 5 to 7% three-bedroom units, right? And so what would happen is you started to have a family as your household formed, right? You would go into the home buying market. But even when rates were good, the supply of homes that you could buy was just simply too few. And so what wound up happening over that time is the price of homes surged. And now you have the rate run-ups on top of what was already historically high home prices, and people have nowhere to go. And so the only place, I think, for those folks to turn is a rental community like ours.
And then finally, we talked about tariffs, we talked about interest rates. What about the immigration piece, which I know is important for the construction industry? Are you seeing already any kind of worker shortages, for example?
Not yet, but it's certainly on everybody's mind.
Gotcha. And what about in terms of wages that you're paying to folks who are there on the job?
So we're going through contractors, right? And so what we're hearing from our contractors is that's a very real concern, right? But you have high interest rates right now, you have tariffs that are looming, you also have, at the same time, immigration prices. So it's really a perfect storm for housing.
Right. Thank you so much for coming in.
Thanks for having me.
Not great stuff for affordability, but appreciate the perspective, Adam. Well, U.S. stocks closing higher to end a rough week as economic uncertainty whipsawed markets. Yahoo Finance's Jared Blickry joins us now with the trading day takeaways.
Thank you, Julie. It was a nice week. Oh, well, it was a nice day of green, but that kind of stands in contrast to what we've seen recently. So my first point is caveat dip buyers, and dip buyers is exactly what we were seeing today. Excuse me. Let me just rattle off some market stats for you. I'm going to show you the sector action, how it broke down this week, and I'll get to that in a second. By the way, in spite of today's price action, and this was a very nice board here, this is what happened today. Tech XLK had its best day in months, best day of the year for sure. This is what happened this week, and you can see things start to get red here. The energy and utility still in the green. Then let's do 10 days, because that's how many trading days have been in March so far, and now we're looking at some serious losses. Consumer discretionary, that's a home to Amazon and also Tesla, that was down the most, down 0.9%. And I had a chance to talk to JJ Kinahan over at Tasty Trade about the dip buyers, and in just general, that was our word of the day actually, phrase of the day, dip buyers. Here's what he had to say on stocks in translation.
I do think it's a sentiment indicator, and when people think that some trouble in the market is a temporary, if you see more people buying the dip, I think what they're really saying is we have confidence in the market overall longer term. We have confidence that we're going to see the bounce back. What's been very interesting to me, though, this last 2 weeks is if you think about the buy the dip mentality, one of the things that has often paid off for people is in that last half hour of trading on tough days, they come in to buy the dip and you see a bounce. You might see the S&P 500 bounce 20 points, bounce 25 points. You haven't seen that as much in these last couple of weeks.
All right, so there you have it. But, we want to quantify these things, and that's something I've been trying to do. So that brings me to the next topic of the day, too fast, too furious. And Julie, you might appreciate this. I looked at all the times in history that the S&P 500 has dropped from a record high to correction, and that's down 10%. And I found about, 27 instances throughout history. Now, the ones that happened within 1 month, that's 21 trading days, and this one happened in 15 days, those saw some pretty good returns. In other words, we saw the market bounce back. The dip buyers won the day. And here you can see 1 week out, median returns of 2.3% with a 90% positive rate. 2 weeks gets a little dicey. Median returns go negative. Then 1 month, still a little bit dicey with only 60% returns. But then when you get a quarter out, it's back up to 100% with 5.4% returns. A year out, 90%, 22% returns. So this is in contrast to what we're seeing if we actually hold. So if we get that drop within 2 to 6 months, and that's when you get that 10% drop, then that's more dangerous territory because it's taken longer. And I notice a lot of recessions tend to happen in there. That's one of the big topics. So the fact that we dropped so quickly from this point is actually a bullish catalyst, at least looking for it. And that's kind of a silver lining.
I guess so. Turning the lemons into lemonade, I suppose,
Yes,
Jared.
something
Okay,
like that.
what else are you watching?
All right, so I'm also watching gold. Gold hit 3,000 an ounce, so I think pay a little tribute there. Might call it Danegeld. I think that's what they called it back in the day. This is, we want to put our futures board on here. Let me just put a year to date, because metals in general have been carrying the futures this year. HG equals F. You want to touch that real quick? That's copper. Yes, it is. And let me put a year-to-date chart on there. You can see this is actually a pretty significant high. I'll put a 40-year. See if we can go back.
Can I ask you something about copper for a minute? Because copper is not like other precious metals, or at least not traditionally, right? It's seen more as an economic proxy.
Yeah.
And so it's really fascinating. I mean, gold is a place that people go when they feel nervous. Copper isn't necessarily, right, historically?
No, it's they call it Dr. Copper because it's supposed to have a PhD in the economy.
Right.
That's kind of the joke. I think it's reacting more to the supply characteristics because you have tariffs in play now. Historically, it was a great demand indicator, and it was closely correlated with China. Now, we still have China playing into the copper story, but it's just in a different way with all the tariffs. I think the bottom line is that we need a new playbook for a lot of these things, and we're trying to figure out what that looks like. So here's copper going back to basically 2000, and you can see we're at the highest prices on that chart, or very close to them. Silver, SI equals F. There you go. We're looking at the highest prices within a few dollars, going back to that post-global financial crisis run that we had all the way up to $50. That was the high end here. Well, now it's $34. And then finally, let's hit gold here. That's up 12.7% this year. And you can, let me point this down to ratchet this down to a one-year chart, and there we go. So it's only at $29.95 right now, but it did hit 3,017, I think was the record high today. And you can see it's up 38% over the last year. It's outperforming just about everything.
And that's unusual to see that magnitude of a gain for gold also.
Yeah, the outperformance and just the magnitude itself.
Yeah,
exactly.
Definitely.
Oh, thank you.
Have a good weekend, Jared.
Take that, Josh.
All right, stick around. Much more Asking for a Trend still to come. Breaking news now, Klarna finally filing for its long-awaited initial public offering. The company looking to go public on the New York Stock Exchange under the ticker symbol KLAR. Details on a price range and the number of shares in the IPO not included in this filing. It's what's known as a placeholder. It's been previously reported that Klarna will look to raise at least $1 billion in its IPO, target a valuation of more than $15 billion. Joining me now is Greg Martin, Rainmaker Securities Managing Director. Greg, I know that there are a number of IPOs that we've been waiting for a long time. Klarna among them. And does this tip the scales in any way? What's your thinking around this one?
Well, it's a great sign. We have been waiting for a while, as you point out, and there's a few others, in the pipeline. Klarna was expected to be one of the first. It's a scale company, very similar to a firm with a broader product offering. So I think it's a good sign that after a turbulent week in the market with some uncertainty around tariffs and potential recession, that they thought, and the bankers think that it's a good time to file. So I think it's a good sign. Obviously, we'll wait to see how the roadshow and the pricing goes, but I think we're all excited to see a big name like Klarna filing, their S1 publicly.
And this is one, as you mentioned, it's in that buy now, pay later space. Like a firm, Klarna, relatively well known in terms of a consumer-facing name, right? So does there tend to be a correlation between that then and sort of retail demand in the market?
I mean, certainly historically true. Obviously, we'll see what it's like going forward. I mean, Klarna is I think their customers spend over $100 billion a year with Klarna. I haven't had a chance to view the current S1, but it's of the scale of a firm. So I do think it shows some confidence in the consumer market. If you think about Klarna's model, they get they start with a buy now, pay later solution. But then you become a customer on their overall portal and there's shopping associated with it. There's future credit opportunities. So I do think it shows some confidence in the consumer market, but obviously, we'll see what the future holds for someone like Klarna, and we'll see how the investors view it on the roadshow. Yeah,
also interesting because I believe Klarna is registered as a bank. So given the interest rate environment, we'll see what those dynamics look like going forward. Greg, there has been a lot of talk that, we have seen some fits and starts in this IPO market, right? That, okay, things are opening up. We keep getting that message, and then it keeps getting slammed shut again. How are you thinking about that right now, especially with the volatility in the market, with all of the concerns over tariffs and the effect on business decision making?
Right. After the Service Titan IPO, I think there was a lot of excitement that we might see, a substantial tech IPO boom. Obviously, we've had some delays. We had a new administration. We've had some tariffs. We've had some turbulence. I mean, some may argue it was just a natural correction of a very heated market. We're seeing the volatility measured by the VIX to be relatively high. So I think that this is a testing point. We haven't seen the flow that we had expected, and now we're already, almost through the end of Q1, and so we won't have a major, venture-backed tech IPO probably pricing until Q2. But I think Klarna becomes a really interesting benchmark that will be watched very closely. Last year's IPOs, even though there weren't many in the tech sector that I cover, all performed very well, and so we had a lot of excitement when we were starting this year. We have other companies like CoreWeave and Chime, that are continuing to follow potentially behind Klarna's IPO. So I think this will be very closely watched, and there's a lot of excitement around it.
And just quickly, when you say very closely watched, like not just the roadshow, but what will people be watching for in particular? Sort of where it prices, the reception that first day of trading, the first couple months. What's going to be really important there?
Yeah, I mean, all of the above. I mean, we're gonna learn a lot in the first week. We'll see whether it'll start with the filing range. We'll see, how conservative the bankers are. They'll have some kind of pre-marketing sense of demand. We'll see after the first week if that changes. So we'll just get a sense of the conservatism. We'll get a sense of the demand. How subscribed is it? And then of course we'll see the aftermarket performance. So I think we're just trying to test the market receptivity for a new issue. And this will be a great test case.
Greg, thanks for hopping on to react to this breaking news. Appreciate it.
Great to see you. Thank you.
Well, Rubrik not seeing a slowdown in its business, reporting a narrower than expected loss for the fourth quarter and upbeat first quarter guidance. Yahoo Finance executive editor Brian Sozzi had a chance to speak with CEO Bipul Sinha on the quarter and on business growth.
All eyes on shares of Rubrik after the company really blew away analyst estimates, served up a really good outlook. I want to get right to the man of the hour, so to speak, Bipul Sinha, co-founder and CEO of Rubrik. Bipul, it's been a while. Last time I physically saw you was on the floor of the exchange for your IPO day, so welcome back to Yahoo Finance. Before we get to your quarter, I mean, the stock is ripping over 25%. Maybe remind the Yahoo Finance ecosystem or universe what Rubrik is doing, because I think it underscores a lot of things that a lot of investors saw in the quarter.
Thank you, Brian, for having me on your program, and it is great to see you again. Rubrik is a cybersecurity company. We focus on cyber resilience, which essentially means that the businesses can keep their business up and running even when they are confronted with a successful cyber attack, so that schools can still take kids, hospitals are remaining open for patients, and banks can dole out money even when they had a successful cyber attack. Because our fundamental thesis is you can't prevent the unpreventable. You can't stop all attacks. So you have to be ready to keep your services up and running despite a successful cyber attack. And that's where Rubrik is winning. We are creating a new market in cybersecurity, and we are the leader of this cyber resiliency space.
Why do you call it cyber resiliency instead of cybersecurity? So I talked to so many of your competitors, and they're still using the terminology cybersecurity.
If you look at the last 15, 20 years of cybersecurity, it was all about prevention of attack, all around infrastructure security, from cloud to network to endpoint and SaaS and all of that. And it was all about taller walls and wider moats to prevent attacks from coming in. We took a completely different approach. Our approach was that you can't prevent the unpreventable. You need to assume that the breaches and attacks will happen to you. But how do you continue to operate the business? And that requires fundamental resilience of the business to bounce back up and continue to operate. So we created this new market around cyber resiliency, which is all about how do you prepare for the eventual cyber attack risk, and how do you recover your business so that you can continue to serve your customer, continue to be a continuing operation.
Bipul, I was looking back at your stock chart on Yahoo Finance since the IPO in 2024, and I was trying to overlay with, so I mean, it's up and to the right, but if you overlay it with the pace of development in AI, there's a lot of correlation, I imagine. Are companies coming to you because they're concerned that with all this new AI and all this new technology, things are moving so fast that they might see breaches?
Look, as the businesses are getting ready for AI and adopting AI, they need to do multiple transformation. They need to transform their cloud posture. They need to transform their data security postures to be able to deliver responsible AI. And that's what we are doing. We are making sure that our customer data has integrity, their business services are up and running, and ensuring that only the right user has the right data at the right time on the right platform to be able to deliver responsible AI. So AI is definitely a tailwind for our business.
The quarter that investors saw today, really well-received results, well-received guidance, quarter and the full year. What's different today about the business compared to when I last saw you on the exchange?
When we spoke last, I said that our focus is to building an enduring business. And I'm a capitalist. And for an enduring business, the business has to be profitable, business has to generate cash. And that's what we did this year. Not only we delivered 39% subscription ARR growth, but we delivered 75 million in free cash flow in Q4 and the full year cash flow positive. We also tremendously improved our contribution margin by 1,400 basis point year over year. And now we are contribution margin positive for the full year. So not only we are delivering the top line growth, which is super high at our scale, but we are also delivering profitability. The combination of the two, creating a profitable growth business, is what will make Rubrik a generational company, and that's what we are focused on.
I would argue, Bipul, that the market's reaction is its way of saying that you will reach profitability at some point soon. Would they be wrong to think that your business hits profitability in the second half of this year, even though that's counter to what you put out there in terms of your guidance?
Look, our goal is to guide the market to the best of our ability to what we see and what we can take advantage of the market opportunity, and how people perceive it we can't control. But we see a tremendous opportunity in this market. Cyber resiliency is the number one priority for our customers. Last year, I did more than 400 CIOs and CISOs meeting around the world. And what is clear is that they're really worried about making sure that the business are continuing operation. They're making sure that their AI is successful. And we are delivering to those needs.
Lastly, before I let you go, Bipul, this has been a weird time. I mean, let's put your stock over there for a second. I mean, the market's been under pressure. There's concerns about policy, what's happening, what may not happen. Now, I asked the CEO of DocuSign. They reported earnings last night. Its stock's going up. Alan Tigason, is he seeing any slowdown in his business? He said he didn't see anything in February. So I want to put the same question to you. Anything that gives you pause in the trends in your business, given everything we've seen in the markets this month?
We are seeing continuous secular strong demand for our product. We are not seeing any significant impact from any macro or any other disruption. So we are very confident about delivering a strong year and continuing on our vision to create a future in cyber resilience.
Well, keep on doing what you're doing. Looking forward to continuing to following your story, of course. Bipul Sinha, co-founder and CEO of Rubrik. We'll talk to you soon. All right, do stick around. Much more ahead on Asking for a Trend.
Policy uncertainty is spooking Americans when it comes to their jobs and inflation. Yahoo Finance's Josh Shaver joins me now with a closer look in our chart of the day.
All right, Julie, I cheated today. We have charts of the day. We have two charts, but I want to start with inflation. So what we're looking at here is long-run inflation expectations. This is from the University of Michigan survey from March. This was released this morning. What you see here is Americans expecting the inflation rate to hit 3.9% over the next 5 to 10 years. That is the highest level that we have seen this since 1991. Really, tariffs driving this, overall policy uncertainty driving this. And the fear here would be if long-run inflation expectations become unanchored, as economists often say, then perhaps inflation itself would remain sticky, right? If we accept higher prices, then maybe prices will actually just stay higher. So that's the inflation side of the story. But there's another interesting chart in the University of Michigan survey today. So this is looking at what consumers expect for unemployment. The overall employment outlook here hitting its lowest level since 2008. So we haven't seen this since the great financial crisis. And what this is telling us, or perhaps telling us, is consumers, again, this uncertainty that we're getting from the Trump administration on policy, driving just an overall downward outlook. And the concern there would be if people are afraid that they're not going to have jobs in the future, would they maybe spend less? So this is survey data. We'll see what we get in hard data in things like retail sales on Monday.
Thanks, Josh. Appreciate it. That's a wrap on today's Asking for a Trend. Have a great weekend.